When the market visits the same low 3 times and refuses to break through, that's not coincidence. It's the floor being defended by real buyers who keep showing up at the same price. The triple bottom is one of the most reliable bullish reversal patterns in trading when you trade it with discipline. Today, the anatomy, the volume signature that confirms it, the trigger that matters, and the trap of buying the third test instead of waiting for the actual breakout. Here's the anatomy. Price drops to a low, bounces, drops back to roughly the same low, bounces again, and drops to that same low a third time before reversing. 3 touches at approximately the same price, with 2 intervening highs that form a flat or slightly rising neckline. Each test is buyers stepping in at the same level, different participants, same conclusion. This price is too low. The pattern only resolves bullish if the third low holds and price closes above the neckline. Here's the volume signature that separates the real triple bottoms from the failures. Each successive low should print on lighter volume. Fewer sellers willing to keep pushing, fewer participants. By the third test, volume should be visibly drier than the first. That fade in selling pressure is the chart telling you sellers are exhausted, and the next decisive move is more likely to be up. Heavy volume on the third low is your warning that the pattern is failing. Now the trade. You don't buy the third low, that's anticipation. You buy the close above the neckline on a visible volume surge. That's the confirmation that real demand has finally taken the level. Your stop goes just below the third low. A return there means the pattern has failed and buyers have given up. Your target is a measured move, the height from the support floor to the neckline, projected up from the breakout. Defined entry, logical stop, math-based target. Now the trap. The third low looks like a free buy, price is right at support, sellers look exhausted, and buying there gets you a tighter entry. The problem, that's anticipation, not confirmation. Plenty of triple bottoms fail at the third test and break down to a new low, especially in a wider downtrend. Wait for the close above the neckline every single time. You'll give up a few percent of upside on the winners, and you'll dodge every failed pattern loss. The math favors discipline. On any liquid stock chart, scroll back to its major bottoms and you'll find the pattern. The ones that worked all share the same fingerprint. 3 clean tests of a flat support floor, volume fading on each successive test, and a decisive close above the neckline on a volume surge. The ones that failed broke down on heavy volume at the third test with no neckline reclaim. Train your eye to demand all 3 confirmations before you commit, and the pattern starts paying you reliably. So, a triple bottom is 3 rejections of the same low, with volume fading on each successive test capped by a neckline. You buy the close above the neckline on a volume surge, stop below the third low, target the measured move. Don't anticipate the third test, wait for the trigger. Done with discipline, it's one of the highest conviction reversal setups in the playbook. Subscribe for the full method and trade your own plan. Education, not financial advice.